Chapter 9 and 10. From Chapter 9 to Chapter 11, we will deal with company's capital investment decision. We will discuss capital budgeting and cash flow analysis in Chapter 9, capital budgeting and decision criteria in Chapter 10, and then capital budgeting and risk in Chapter 11. The first step in capital budgeting process is to estimate cash flows associated with the project considered. So we may first ask, what are relevant cash flows? Typically, it includes an initial cash outflow termed net investment and net operating cash flows, which are expected to generate over the project life. Net cash flows should be measured on an incremental basis and an after-tax basis. On an incremental basis means only changes in cash flow stream resulting from undertaking the project should be considered. Net investment. The project's initial net cash outflows can be calculated using the following steps. The new project cost plus any installation and shipping costs associated with acquiring the asset and putting it into service, plus any increases in net working capital initially required as the result of the new investment, minus the net proceeds from the sale of existing assets when the investment is a replacement decision, plus or minus the taxes associated with the sale of existing assets and or the purchase of the new assets. What should you do if the investment project requires outlays over more than 1 year before positive cash inflows are generated? Net investment is then calculated as the present value of the series of outlays discounted at the firm's cost of capital. The calculation of net operating cash flows over the project life is given in the formula presented here and summarized in this table. We will talk about the recovery of after-tax salvage value in the example discussed. The total amount of accumulated net working capital is usually recovered at the end of the life of the project. The resulting decrease in net working capital represents an increase in net cash flow. The reason is that net working capital or working capital, these two terms are often used interchangeably, is defined as the difference between current assets and current liabilities. An increase in net working capital means a positive change in net working capital, that is, the difference between current assets and current liabilities is positive. Current assets represent the uses of cash, while current liabilities represent the sources of cash. Therefore, a positive difference between current assets and current liabilities means a net use of cash, that is, a decrease in net cash flow. Now, a decrease in net working capital means a negative change in net working capital, that is, the difference between current assets and current liabilities is negative. Thus, a net source of cash, which means an increase in net cash flow. Note, there are generally no tax considerations associated with the recovery of net working capital. Be careful, interest charges are not subtracted when estimating net operating cash flows for two reasons. First, the decision about how a firm should be financed should be made independently of the decision to accept or reject one or more projects. Second, the cost of capital, that is the discount rate, already incorporates the cost of funds used to finance a project. Therefore, subtracting interest charges from net operating cash flows will consider the cost of funds twice. Now, we are going to illustrate estimates of relevant cash flows using two examples. The first example is an asset expansion project. The equipment will cost $50,000. Shipping and installation charges are expected to be $5,000. The equipment will be depreciated over its 5-year economic life on a straight-line basis to the estimated salvage value of 0. The project will require an initial increase in net working capital of $7,000. After the asset expansion, total revenues will increase by $50,000 above the level that would have prevailed in year 1, $60,000 in year 2, $75,000 in year 3, decline to $60,000 in year 4, and decline to $45,000 in year 5. After the asset expansion, operating costs will increase by $25,000 in year 1 and will increase at a rate of 6% per year over the 5-year project life. The marginal tax rate for the company is 40%. Net working capital will increase by $5,000 per year in years 1, 2, and 3, and by 0 in years 4 and 5. At the end of the life of the project, the total accumulated net working capital required by the project will be recovered. We would like to determine relevant cash flows, including net investment and net operating cash flows of each year over the 5-year project life. Let us first calculate net investment by using the steps introduced in the previous slide, which are the new project cost plus any installation and shipping costs associated with acquiring the asset and putting it into service. In this example, it is $50,000 plus $5,000 plus any increase in net working capital initially required as a result of the new investment. In this example, it is $7,000 minus the net proceeds from the sale of existing assets when the investment is a replacement decision. In this example, it is an asset expansion project, so it is 0, plus or minus the taxes associated with the sale of the existing assets and or the purchase of the new assets. In this example, it is 0. Therefore, net investment for this project is $62,000. Let us now turn to calculate annual net operating cash flows over the project life by using this summarized table introduced earlier. Changes in total revenues from year 1 to year 5 are provided here. They are given explicitly in the problem. Changes in operating costs from year 1 to year 5 are calculated here using the information provided in the problem. In year 1, the change in the operating cost is $25,000 because the operating cost will increase by $25,000 given in the problem. From year 2 to year 5, changes in operating costs are calculated by the change in the operating cost in the previous year times 1 plus 6% because operating costs will increase at a rate of 6% per year over the 5-year project life. For example, in year 2, it is calculated by the change in the operating cost in year 1 times 1 plus 6%. In year 3, it is calculated by the change in the operating cost in year 2 times 1 plus 6%. And you can apply the same logics to calculate changes in operating costs in year 4 and year 5. Annual depreciation cost using the straight-line depreciation method is calculated by the formula. Annual depreciation amount equals cost of the asset minus salvage value divided by number of years over which the asset is depreciated. We have cost of the asset, which actually refers to the sum of the purchase price of the asset and shipping and installation costs, equal to $50,000 plus $5,000 equal to $55,000. Salvage value of 0 and number of years over which the asset is depreciated equal to 5. After calculation, the annual depreciation amount is $11,000. Changes in net working capital from year 1 to year 3 are $5,000 every year because net working capital will increase by $5,000 every year from year 1 to year 3, and there is no change in net working capital in year 4 and year 5. Thus, the value is 0 in year 4 and year 5. At the end of the life of the project, the total amount of accumulated net working capital required by the project will be recovered, which is $7,000 for the increase in the initial net working capital, plus $5,000 every year from year 1 to year 3. It is negative because the recovery of the total amount of accumulated net working capital represents the source of cash. Putting all estimates together, we can then obtain this annual net operating cash flows table. Be careful when performing minus a negative number, that is, subtraction sign followed by a negative sign, it turns the two signs into a plus sign. That is, instead of subtracting a negative, you are adding a positive. We can actually draw the cash flow timeline using the estimates of annual net operating cash flows to have good visualization of relevant cash flows. The second example is an asset replacement project. The old automated drill press was purchased 10 years ago with an estimated economic life of 20 years. It originally cost $150,000 and it has been fully depreciated. That is, the book value of the old drill press is 0. The actual market value of this drill press is $40,000. The new drill press considered for replacement will cost $190,000, and shipping and installation charges are expected to be $10,000. The new drill press would be depreciated over its 10-year economic life on a straight-line basis to the estimated salvage value of 0. The expected market value of the new drill press at the end of 10-year period would be $25,000. After the replacement, annual revenues will increase from $70,000 to $85,000 in year 1, and will increase at the rate of $2,000 every year from year 2 to year 10. Annual operating costs will fall from $40,000 to $20,000 in year 1, and will then increase at a rate of $1,000 every year from year 2 to year 10. There is no change in net working capital. The company's marginal tax rate is 40%. We would like to determine relevant cash flows, including net investment and net operating cash flows of each year over the 10-year project life. Let us calculate the net investment by using the steps shown here. The new project cost plus any installation and shipping costs associated with acquiring the asset and putting it into service. In the current example, it is $190,000 plus $10,000 plus any increases in net working capital initially required as a result of the new investment. In the current example, it is 0, minus the net proceeds from the sale of existing assets when the investment is a replacement decision. In the current example, it is $40,000, plus or minus the taxes associated with the sale of the existing assets and or the purchase of the new assets. In the current example, the sale of old drill press would incur a tax liability of $40,000 times 40% equal to $16,000. It is a cash outflow, so we would choose plus. The net investment then equals $176,000. Changes in revenues are calculated here using the information provided in the problem. The change in the revenue in year 1 is calculated as the difference between $85,000 and $70,000 equal to $15,000 because the annual revenue will increase from $70,000 to $85,000 in year 1. Changes in revenues from year 2 to year 10 are calculated at an incremental of $2,000 every year because annual operating revenue will increase at a rate of $2,000 every year from year 2 to year 10. Changes in operating costs are calculated here using the information provided in the problem. The change in the operating cost in year 1 is calculated as $20,000 minus $40,000 equal to negative $20,000 because the annual operating cost will fall from $40,000 to $20,000 in year 1. Changes in operating costs from year 2 to year 10 are calculated at an incremental of $1,000 every year because the annual operating cost will increase at a rate of $1,000 every year from year 2 to year 10. Note: the reason changes in operating costs are negative is that asset replacement yields cost savings. We also note that the savings decreases every year once the new asset is put into service. Annual depreciation cost using the straight-line depreciation method is calculated by the formula annual depreciation amount equals cost of the asset minus salvage value divided by number of years over which the asset is depreciated. We have cost of the asset, which actually refers to the sum of the purchase price of the asset and shipping and installation costs, equal to $190,000 plus $10,000 equal to $200,000, salvage value of 0, and number of years over which the asset is depreciated equal to 10. After calculation, the annual depreciation amount is $20,000. There is no change in net working capital from year 1 to year 10. For this problem, we don't have recovery of net working capital at the end of the life of the project because there are no initial net working capital required and no changes in net working capital through the life of the project. We do have recovery from the salvage value of this new drill press. The company is expecting to recover $25,000 of the new drill press by selling it on the market at the end of the life of the project. Meanwhile, the sale of this new drill press at the end of the life of the project is expected to incur the company a tax liability of $10,000, which is calculated as $25,000, the sale price of the new drill press, times 40%, the company's marginal tax rate. Putting all estimates together, we can then obtain this annual net operating cash flow table. We can also summarize the estimates of annual operating cash flows as the table shown here to have good visualization of relevant cash flows. Chapter 10, Decision Criteria. We will discuss net present value, profitability index, internal rate of return, and payback period. Net present value is defined as the present value of the stream of future cash flows from a project minus the project's net investment. For independent projects, a project will be accepted if its net present value is greater than or equal to zero, because it means the present value of future benefits is at least sufficient to justify the investment outlay. For mutually exclusive projects, the project with the largest net present value will be selected. Mutually exclusive projects refer to a set of projects out of which only one project can be selected for investment. A decision to undertake one project from mutually exclusive projects excludes all other projects from consideration. We will first use the asset expansion project discussed in Chapter 9 to illustrate the use of net present value. The cost of capital, that is, the discount rate, is 15%. We obtained these cash flow estimates from Chapter 9. To obtain net present value, we can use the TIBA2 Plus or Plus Professional Financial Calculator with the built-in cash flow worksheet function. The detailed steps are described here. Or we can use the table of present value interest factor to obtain the present value of each future cash flow separately, sum them together, and then minus the initial net investment to obtain net present value. After calculation, net present value is greater than zero, so the asset expansion project is accepted. Note: due to the rounding error, you may get a slightly different value using these two different methods. The second example is the asset replacement project from Chapter 9. We obtained these cash flow estimates from Chapter 9. We can repeat the same calculation steps discussed in the asset expansion project to obtain the net present value of the asset replacement project. After calculation, net present value is less than zero, therefore, the asset replacement project is rejected. Profitability index is defined as the ratio of the present value of expected net cash flows over the life of a project to the net investment. In other words, it measures the present value return for each dollar of the initial investment. Not surprisingly, for independent projects, a project will be accepted if its profitability index is greater than or equal to 1, because it means for every dollar of your investment, you get at least $1 in return. Expressing this criteria in equation, we can also find that profitability index greater or equal to 1 also indicates net present value greater or equal to 0. For mutually exclusive projects, the project with the largest profitability index will be selected. Conflicts may occur between net present value and profitability index for mutually exclusive projects. We will discuss this in detail later. We will illustrate the calculation of the profitability index with the asset expansion project. You can use the table of present value interest factor to calculate the present value of each expected net cash flows separately and sum them together to obtain the present value of expected net cash flows over the life of a project. The value of the net investment is given. After calculation, profitability index is greater than 1, so the asset expansion project is accepted. Now, if you obtain the net present value by using the financial calculator, you don't need to recalculate the numerator number, the present value of expected cash flows over the life of a project. What you have to do is to sum the net present value obtained and the initial net investment together. We would like to discuss a scenario where the net present value criteria and the profitability index criteria yield conflicting investment decisions for mutually exclusive projects. Let us use the example shown here for the discussion. Project J and Project K are mutually exclusive projects. Project J yields a higher net present value, but with a lower profitability index. So, by the net present value criteria, Project J should be selected, but by the profitability index criteria, Project K should be selected. How should we solve the problem? If there is no capital rationing, that is, there are no constraints on funds available to investment projects, we should go with the net present value criteria. That is, we should choose the project yielding the largest net present value. In this example, we should choose Project J. The reason by using the net present value criteria here is that we can generate the largest total dollar increase in the firm's value consistent with the goal of the firm, maximizing the firm's value, that is, maximizing the shareholders' wealth. If there is capital rationing, that is, there are constraints on funds available to investment projects, we should go with the profitability index criteria, that is, the project yielding the largest profitability index should be selected. In this example, we should choose Project K. The reason is that within the amount of cash allowed to spend, we would like to get the maximum benefit for every dollar spent. Therefore, we should choose the project which can yield the maximum return per dollar of investment. Internal rate of return is defined as the discount rate that makes the net present value equal to 0. Therefore, the higher a project's internal rate of return, the more desirable it is to undertake the project. For independent projects, a project will be accepted if its internal rate of return is greater than or equal to the cost of capital. For mutually exclusive projects, the project yielding the highest internal rate of return should be chosen. Conflicts may occur between net present value and internal rate of return for mutually exclusive projects. We will discuss this later in detail. We will first use the asset expansion project to illustrate how to solve the internal rate of return of a project. Here are steps using the financial calculator to obtain the internal rate of return. The steps are exactly similar to the steps calculating the net present value. The only difference is the last step. Now, instead of pressing CPT to obtain the net present value, you have to press IRR CPT to obtain the internal rate of return. After calculation, internal rate of return is greater than the cost of capital, so the asset expansion project should be accepted. We continue to illustrate how to solve the internal rate of return of a project using the asset replacement project. These are cash flow estimates for the asset replacement project obtained in Chapter 9. Here are steps using the financial calculator to obtain the internal rate of return. After calculation, internal rate of return is less than the cost of capital. Therefore, the asset replacement project should be rejected. By looking at the formula of net present value, we see that the net present value calculation assumes cash flows are reinvested at the cost of capital, whereas the internal rate of return assumes that cash flows are reinvested at the internal rate of return. There are two major problems associated with the internal rate of return. The first one is the possible existence of multiple internal rate of returns. You may find more than one internal rate of returns when there are cash flows with alternating signs. The second one is the unreasonable reinvestment rate assumption. As just mentioned, the internal rate of return assumes that cash flows are reinvested at the computed internal rate of return. That is, if the project is an eagle, you are assuming you can reinvest funds at eagle rates. If the project is a turkey, you are assuming that you are willing to reinvest funds at turkey rates. Consequently, there is a modified internal rate of return to overcome these two major problems. The modified internal rate of return is the rate of return you can earn for the amount invested today, assuming future cash flows generated from the project can be reinvested at the appropriate rate, which is in general assumed to be the cost of capital. We use the asset expansion project to illustrate how to use the TIBA2 Plus Professional to obtain the modified internal rate of return. The reinvestment rate is assumed to be the cost of capital 15%. Here are the steps performing the TIBA2 Plus Professional. The steps are exactly similar to the steps calculating the internal rate of return. After computing the internal rate of return, you will press down arrow key and the financial calculator will ask for the reinvestment rate, which is 15% in this example. So you input 15, enter, and then down arrow key CPT. The number shown in the financial calculator is the modified internal rate of return. In this example, the modified internal rate of return is 19.59%, greater than the cost of capital, so the asset expansion project should be accepted. If you don't have TIBA2 Plus Professional, one alternative is to calculate the future value of each cash inflows using the cost of capital as the interest rate. That is, find out the future value of the first cash inflow at the end of year 5 by having PV equal to $14,400, payment equal to 0, number of periods equal to 4, interest rate equal to 15%, compute future value, find out the future value of the second cash inflow at the end of year 5 by having PV equal to $19,500, payment equal to 0, number of periods equal to 3, interest rate equal to 15%, compute future value, and apply the same techniques to find out the future values of third, fourth, and fifth cash inflows at the end of year 5. Then add all the future cash flows together to get one lump sum future value. In this example, the lump sum future value is obtained as this number. Once you obtain the lump sum future value, you can use this value to compute the interest rate. This value is going to be input as the future value. The present value is the net investment, a cash outflow. The number of periods is 5. Compute interest rate. The interest rate you obtain is the modified internal rate of return. Now, we would like to discuss the conflict occurs between the net present value decision rule and the internal rate of return decision rule for mutually exclusive projects. If Project M and Project L are independent projects for the cost of capital less than 18.3%, both the net present value decision rule and the internal rate of return decision rule yield the same investment decision, that is, undertaking both investment projects because the net present values for both projects are larger than or equal to 0, and the internal rates of return for both projects are larger than or equal to the cost of capital. If Project M and Project L are mutually exclusive, then we find that if the cost of capital is larger than 10%, project L should be chosen based on the net present value decision rule and the internal rate of return decision rule because both the net present value and the internal rate of return for the project L are larger. If the cost of capital is less than 10%, project M should be chosen based on the net present value decision rule because the net present value for the project M is larger. However, with the internal rate of return decision rule, project L should be chosen because the internal rate of return for project L is larger. In general, the cost of capital is assumed to be a more realistic reinvestment rate than the computed internal rate of return. Therefore, if the cost of capital is less than 10%, project M should be chosen. If the cost of capital is larger than 10%, project L should be chosen. The last criteria we would like to discuss is the payback period. Payback period is used to measure the length of time required to recover the cost of an asset. So, if expected net cash inflows are equal each year and the discount factor is not considered, payback period can be easily calculated by net investment divided by annual net cash inflows. We can, of course, consider the discount factor and calculate the discounted payback period by discounting the net cash inflows at the firm's cost of capital. Under the payback period, a project will be accepted if the payback period is less than or equal to a specified maximum period of recovering the cost of an investment. You will not be tested for the calculation of payback period. Now, we would like to discuss some more issues related to the valuation and decision rules of capital budgeting problems. Consider the inflation. The cost of capital already includes the effects of expected inflation. All cash flow estimates should also be adjusted to reflect anticipated inflationary increases. What should a firm do if it does not have enough money to invest in all of its positive net present value projects? If a firm has a capital budgeting constraint, that is, a capital rationing problem, the Profitability Index should be used to rank the projects from highest to lowest, and then begin with the project with the highest Profitability Index, proceed through the lists, and accept projects having the Profitability Index greater than or equal to 1 until the entire capital budget has been utilized. What should a firm do when the next acceptable project is too large? The problem can be solved by searching for another combination of projects that will increase the cumulative net present value, attempting to increase the capital budget, or investing excess funds in short-term securities. Now, will the managerial flexibility such as timing flexibility, contraction and expansion flexibility in response to market conditions, abandonment flexibility, impact the valuation of investment projects? The answer is yes. It may actually turn unprofit projects into profit projects. So, how do we accommodate these flexibilities into valuation? We can apply real options technique, that is, applying options pricing technique on real assets.